If you walk into any business school today, you will be taught a very specific set of rules to protect your money. The golden rule is diversification. You build a portfolio of 40 or 50 different stocks, so if one of them collapses, the damage is absorbed by the rest. Then there is Stanley Druckenmiller. From 1981 to 2010, managing billions of dollars, he delivered an annualized return of 30%. Over those 3 decades, through the Black Monday crash, the dot-com bust, and the 2008 financial crisis, he had 0 down years. To understand the math of a 30% return compounded over 30 years, consider this. An initial investment of $100,000 would grow to roughly $260 million. He achieved this flawless record by aggressively ignoring academic finance. He calls the concept of risk-adjusted return and broad diversification nonsense. His philosophy is the exact opposite. Put all your eggs in one basket and watch the basket very carefully. When Druckenmiller structures a portfolio, he strips away the noise. He looks for 2 or 3 massive ideas where he has absolute, extreme conviction, and he ignores everything else. The math creates a glaring contradiction. Concentrating all your capital into just 3 ideas sounds like a guaranteed path to total financial ruin. Yet this exact method produced Wall Street's most perfect track record. This chart illustrates a common reality in fund management. Even if an investor holds 40 different assets, 70 to 80% of their total profits for the year will usually come from just 2 or 3 great ideas. The first mechanic of concentration is accepting that sizing matters much more than accuracy. If you know those top 3 trades are going to drive your entire year, diluting them with dozens of smaller, mediocre bets only drags down your overall performance. In the fall of 1992, Druckenmiller spotted a structural flaw in the European exchange rate mechanism. The British pound was artificially propped up, and the UK government was running out of money to defend it. He was so certain it would collapse, he proposed shorting the pound with 100% of the fund's capital. His boss was George Soros. Soros looked at the proposal, mocked the 100% allocation, and demanded he use leverage to push the bet to 200%. The math dictated the aggression. The maximum potential loss was 0.5%, but the potential gain was 15% or more, a 30-to-1 asymmetrical setup. On September 16th, the Bank of England surrendered. The pound's value plummeted, and the fund walked away with over $1 billion in profit in a single day. That trade cemented the defining rule of Druckenmiller's career. It doesn't matter if you are right or wrong 50% of the time. What matters is how much money you make when you are right, and how strictly you limit your losses when you are wrong. But to find those rare, asymmetrical opportunities, you have to move before everyone else. This requires acting on a fraction of the available information. If you wait until you have all the facts, you will miss the trade completely. Druckenmiller ignores current earnings reports because today's numbers are already reflected in today's stock price. Instead, he visualizes exactly what the world will look like 18 to 24 months in the future and invests in that reality. In the middle of 2022, long before the broader market caught on, he made a massive bet on NVIDIA. He bought a huge position in the stock based entirely on early signals, admitting later that he barely understood large language models and didn't even know how to spell the company's name. He didn't need to be a software engineer to see the shift. He simply noticed that the top-tier engineering students at Stanford were quietly shifting away from crypto startups and moving entirely into artificial intelligence. Concentrating capital demands a high tolerance for ambiguity. If you wait until conventional wisdom agrees with your thesis, the market has already priced it in. The obvious flaw of a highly concentrated portfolio is the risk of an absolute wipeout. To survive, you must be able to escape instantly, which is why this strategy requires trading almost exclusively in highly liquid markets. But liquidity is useless without the right psychology. You have to be entirely stripped of ego, willing to look at a trade you loved yesterday and completely abandon it today. In August 1987, the market was running hot, and Druckenmiller had built a massive long position heading into the weekend. He was positioned for the market to keep climbing. Over the weekend, he reviewed the data and realized he had made a critical mistake. On Monday morning, before the historic Black Monday crash wiped 22% off the market, he liquidated his entire long portfolio and flipped to a short position. completely dodging the disaster. The ability to instantly kill your own highest conviction ideas without hesitation is the primary defense mechanism. It is the only way to protect a fragile, concentrated basket from shattering. Standard diversification exists for a very good reason. It is a highly effective tool for surviving your own blind spots and protecting the wealth you have already accumulated. But Druckenmiller's record exposes a harsh reality about financial markets. To generate true outlier wealth, to literally turn a modest sum into a fortune, extreme concentration is a mathematical requirement. Executing it requires a bizarre psychological paradox. First, you need the supreme arrogance to look at a single, unproven idea and bet the farm on it, while the rest of the world calls you crazy. Then, you have to pair that arrogance with an intense paranoid humility, the kind of humility that allows you to admit you were wrong, swallow your pride, and sell the entire position the very next morning. You do not need to be right all the time to beat the market. But when the math lines up and you find a rare, asymmetrical opportunity, playing it safe is a mathematical error. You must find your basket, fill it up, and guard it with your life.